Reach into your pocket and pull out a banknote. Look at it closely. It's just a piece of paper or plastic with some ink on it. By itself, it's almost worthless. And yet, you can hand it to a stranger and walk away with food, fuel, or a phone. Why? Why does this little slip of paper hold such incredible power? The answer is one of the most fascinating stories ever told, the story of money itself. Today, we trace that story from the very beginning, from seashells all the way to Bitcoin. To understand money, we have to imagine a world without it. Thousands of years ago, there were no coins, no banknotes, no bank accounts. If you were a farmer with grain, and you wanted a pair of shoes, you had to find a shoemaker who happened to want grain. This system is called barter, directly swapping one good for another. And while it sounds simple, it has a crippling problem that held humanity back for a very long time. Economists call that problem the double coincidence of wants. For a trade to happen, both people must want exactly what the other has at the exact same time. The farmer wants shoes, but the shoemaker wants a chicken, not grain. So now the farmer has to first find someone who wants grain and has a chicken, then trade for the chicken, then find a shoemaker. It's slow, clumsy, and often impossible. Barter simply could not support a growing, complex society. Humanity needed something better. The solution that emerged was brilliant. Find one thing that everyone is willing to accept and use it as a middleman for all trades. This is the birth of money. Now, the farmer doesn't need to find a shoemaker who wants grain. He just sells his grain for this commonly accepted item and uses it to buy shoes from anyone. That item became the very first form of money. And throughout history, it took some surprising and strange forms. Different cultures used wildly different things as money. Cattle were among the earliest, valuable but hard to carry. Many societies used cow or seashells, beautiful, durable, and hard to fake. Others used salt, which was so precious for preserving food that Roman soldiers were sometimes paid in it. In fact, the word salary comes from the Latin word for salt. People also used grain, beads, animal furs, and even large carved stones. Anything rare and widely wanted could become money. Some forms of early money were truly bizarre. On the Pacific island of Yap, people used giant stone discs called rice stones as money, some as large as a car and far too heavy to ever move. When someone spent one, the stone simply stayed where it was. Everyone just agreed on who now owned it. It was a perfect illustration of a deep truth we'll return to. Money doesn't need to move or even be touchable. It just needs everyone to agree on who owns the value. But these early forms of money had their own problems. Cattle could die, grain could rot or be eaten by pests. Seashells could be found in huge numbers near the coast, making them unreliable. For money to truly work well, humanity needed something with special properties. It had to be durable so it wouldn't decay, portable so you could carry wealth easily, divisible so you could make change, and crucially, scarce, so it couldn't be easily created. One group of materials fit perfectly: precious metals. Gold and silver were the perfect money. They don't rust or rot, lasting for thousands of years. They're rare and difficult to mine, so the supply stays limited. They can be melted and divided into any size. And they have a beautiful, universal appeal that humans have been drawn to across every culture on Earth. For these reasons, gold and silver became the dominant forms of money for most of recorded history. But there was still one problem to solve. At first, people traded gold and silver in raw lumps, which meant every transaction required weighing the metal and checking its purity. It was slow and open to cheating. The breakthrough came around 2,600 years ago in a kingdom called Lydia in modern-day Turkey. They invented the coin. By stamping a standard amount of metal with an official symbol, they guaranteed its weight and purity. Now money could be counted instead of weighed. The coin was a revolution, and it spread across the world. For centuries, coins ruled the world. Empires rose and fell on their gold and silver. But carrying large amounts of heavy metal was dangerous and inconvenient. Imagine a wealthy merchant needing to move a fortune across a country full of bandits. There had to be a safer way. And the solution to this problem would accidentally give birth to one of the most powerful and misunderstood institutions in human history, the bank. It started with goldsmiths. These craftsmen worked with gold, so they already had strong, secure vaults to protect it. People began asking the goldsmiths to store their gold for safekeeping, and in return, the goldsmith would write them a paper receipt. This receipt was a promise. Present this paper, and you can claim your gold back at any time. It seemed like a simple storage service, but it was about to transform the entire concept of money forever. Here's what happened next. People realized that instead of going to the goldsmith, retrieving their gold, and handing it over for a purchase, they could just hand over the paper receipt itself. The receipt was as good as gold because anyone holding it could claim the gold. So the paper began circulating as money. This was the birth of paper money, the banknote. People were now trading promises of gold rather than the gold itself, and that opened a tempting, dangerous door. Here's a fact that surprises most people. Paper money wasn't invented in Europe. China got there first by centuries, as far back as the Tang and Song dynasties. Over 1,000 years ago, Chinese merchants and emperors were already using paper notes instead of heavy strings of metal coins. When the explorer Marco Polo returned from China and described paper that worked just like gold, Europeans could barely believe him. The idea of money as paper was already ancient on the other side of the world. The goldsmiths noticed something. At any given time, only a small fraction of people ever came to withdraw their actual gold. Most of it just sat in the vault day after day. So the goldsmiths had a cunning idea. What if they lent out some of that idle gold to others and charged interest on it? The original owners still had their receipts and never knew. The goldsmith earned money on gold that wasn't even his. This was the secret birth of modern banking. This practice is called fractional reserve banking, and it's the foundation of the entire modern financial system. It means a bank only keeps a fraction of its deposits in reserve and lends out the rest. It's incredibly powerful because it puts idle money to work, funding businesses and growth. But it carries a hidden danger. If too many depositors demand their money at the same time, the bank doesn't have it all. This is the root of the bank run, a terror we've seen cause crises throughout history. But fractional reserve banking does something even more mind-bending. It actually creates new money out of thin air. Here's how. You deposit $100 in a bank. The bank keeps 10 and lends 90 to someone else. Now you still believe you have $100, and the borrower has $90 to spend. Suddenly, there's $190 circulating, born from your original 100. The bank didn't print anything. It created money simply by making a loan. Repeat this process across the whole economy again and again, and banks multiply the money supply enormously. This is one of the most important and least understood facts about our world. The vast majority of money in existence today was not printed by government. It was created by commercial banks as debt every time they issue a loan. Let that sink in. Most of the money you use every day began its life as someone else's loan. Money and debt are deeply intertwined. As banks and paper money spread, nations realized this system needed a referee, a single powerful institution to oversee it all. So they created central banks like the Bank of England and later the Federal Reserve in America. A central bank is the bank for the government and for other banks. It manages the nation's money supply, sets key interest rates, and acts as a lender of last resort, stepping in to rescue the system during a panic. The central bank became the master controller of money. So how does a central bank actually steer something as vast as a national economy? Its most powerful tool is the interest rate, the price of borrowing money. When the economy is weak, the central bank lowers rates, making loans cheap, which encourages people and businesses to borrow, spend, and invest. When the economy overheats and inflation rises, it raises rates, making borrowing expensive, which cools everything down. With this single lever, a central bank influences the financial life of nearly everyone in the country. This gives central banks staggering, often invisible power. A handful of officials, by adjusting a single number, can decide whether mortgages are affordable, whether businesses expand or lay off workers, and whether your savings grow or stagnate. It's exactly why every word from a central bank chairman is dissected obsessively by markets around the world. These institutions don't just manage money. To a remarkable degree, they manage the entire rhythm of the modern economy, using money they can create from nothing. For a long time, all of this paper money was still anchored to something real. Under the gold standard, every banknote a government issued was backed by and could be exchanged for a fixed amount of actual gold held in reserve. This gave people confidence. Your paper wasn't just a promise from a politician. It was a claim on real, physical gold. The gold standard brought stability and trust to money across the trading world, but also came with a heavy chain. The chain was this: a government could only create as much money as it had gold to back it. That sounds responsible, and in good times it was. But in a crisis, it became a straitjacket. When the economy desperately needed more money to recover, the gold standard prevented governments from creating it. Many economists believe this rigidity is exactly what deepened and prolonged the Great Depression of the 1930s. The very thing that gave money its stability also made it dangerously inflexible. The two world wars put enormous strain on the gold standard, as nations printed money to fund the fighting. By the end of the Second World War, the global financial system was in chaos and needed to be rebuilt. So in 1944, the world's leading nations met in a small town called Bretton in New Hampshire to design a new order for money. The system they created would shape the entire planet, and it placed one currency at the very center of the world. Under the Bretton Woods system, the U.S. dollar became the king of currencies. The deal was elegant. The United States promised to keep its dollar backed by gold, convertible at a fixed rate of $35 per ounce. Then every other country pegged its own currency to the U.S. dollar. So the dollar was tied to gold, and the world was tied to the dollar. It made America the financial center of the planet, and the dollar the world's reserve currency. But depended on one fragile promise. That promise was that America would never print more dollars than it could back with gold. For a while it held. But then came the costly Vietnam War and ambitious social spending programs in the 1960s. To pay for it all, the United States started printing far more dollars than it had gold to support. Other countries grew suspicious. They began demanding to trade their dollars for actual American gold, and the gold started draining out of U.S. vaults at an alarming rate. By 1971, the situation was a crisis. America's gold reserves were vanishing, and there were far more dollars in the world than gold to honor them. President Richard Nixon faced an impossible choice. So on August 15, 1971, he went on television and made a stunning announcement. The United States would no longer convert dollars into gold. With a few words, he severed the link between the dollar and gold completely. This moment is known as the Nixon Shock, and it changed money forever. For the first time in human history, the world's money was backed by nothing physical at all. No gold, no silver, just trust. This is called fiat money. The word fiat comes from Latin, meaning let it be done, or by decree. Fiat money has value simply because a government declares it to be legal tender, and because everyone agrees to accept it. The paper in your pocket today is fiat money. Its value rests entirely on collective belief, and that is a profound and strange thing. Now, this might make you nervous. Money backed by nothing? But fiat money has a huge advantage. Because it isn't chained to gold, governments and central banks can flexibly manage the money supply, expanding it to fight recessions and stabilize the economy. This flexibility is exactly why the response to the 2008 crisis could be so aggressive, preventing a second Great Depression. Fiat money gave humanity powerful new tools to steer the economy, but also handed those in power a very dangerous temptation. The temptation is simple. If you can create money out of nothing, why not just create more whenever you want? More money to fund wars, programs, and promises. But here lies the great danger of fiat money. When you dramatically increase the supply of money without a matching increase in real goods and services, each unit of money becomes worth less. Prices rise. This is inflation, the slow, silent erosion of your money's value. And it is the permanent shadow that follows fiat currency. Let's make inflation crystal clear, because it touches your life every single day. Imagine the total amount of money in a country doubles, but the amount of stuff to buy stays the same. Now there's twice as much money chasing the same goods, so prices roughly double. The money in your savings account didn't change in number, but it now buys half as much. Inflation is essentially a hidden tax on everyone who holds cash. Your money quietly loses power while you sleep. A little inflation is normal, even intended, in modern economies. But when governments lose control and print money recklessly, the result is terrifying: hyperinflation. History is full of horror stories. In Germany in the 1920s, money became so worthless that people burned banknotes for heat and carried cash in wheelbarrows to buy a loaf of bread. Prices doubled in days. People's life savings were wiped out overnight. It was an economic catastrophe born entirely from the printing press. And it wasn't a one-time event. Zimbabwe in the 2000s printed money so wildly it issued a $100 trillion banknote, which could barely buy a bus ticket. Venezuela saw prices spiral so fast that people weighed cash instead of counting it. In every case, the lesson is the same and brutal. Money is only as trustworthy as the people who control its supply. When that trust is abused, the entire value of a currency can collapse into dust. Fiat money is powerful, but fragile. Our modern system, then, is built on a peculiar foundation: money that is created as debt, backed only by trust, and managed by central banks, trying to keep inflation in a careful, gentle balance. It's a system that has fueled astonishing growth and prosperity. But it's also one that requires constant management, faces recurring crises, and quietly transfers wealth through inflation. For many people, understanding this system for the first time is genuinely unsettling, and it led some to ask a radical question. That question was, what if we could create money that no government and no bank could control? Money with a supply that could never be inflated away? For decades, it was just a dream. Then came the 2008 financial crisis. As people watched banks get bailed out and trust in the system crumble, a mysterious figure using the name Satoshi Nakamoto released something into the world. In 2009, the very first Bitcoin was created, and it proposed a completely new kind of money. Bitcoin was radical because it had no central authority at all. No bank, no government, no company. Instead, it runs on a technology called the blockchain, a giant public ledger maintained by thousands of computers all around the world at once. Every transaction is recorded and verified by this global network, making it nearly impossible to fake or tamper with. For the first time, you could send value directly to anyone on Earth without needing a bank in the middle. Money had gone fully digital and decentralized. And here's the feature that excites Bitcoin's believers most. Its supply is mathematically fixed. There will only ever be 21 million Bitcoins, and no one can change that. Unlike fiat money, which can be printed endlessly, Bitcoin is designed to be permanently scarce, like a kind of digital gold. To its supporters, this makes it the ultimate protection against inflation and reckless money printing. It's an attempt to bring back the discipline of the gold standard, but in a purely digital form. But Bitcoin and the thousands of cryptocurrencies that followed are deeply controversial. Critics point out that their prices are wildly volatile, swinging up and down by huge amounts, which makes them difficult to use as everyday money. They've been used for scams and speculation, and they consume enormous amounts of energy. Supporters counter that it's still early, that the technology is revolutionary, and that a new financial system always looks messy at first. The debate over crypto's true future is far from settled. Meanwhile, the established powers are not standing still. Most of the money in the world is already digital anyway, just numbers on screens and bank computers, moved by cards and apps. Physical cash is fading. And now, central banks themselves are developing their own digital currencies called CBDCs. These would be official, government-backed digital money. They could make payments faster and cheaper, but they also raise serious questions about privacy and control, since every transaction could potentially be tracked. The next battle over money is just beginning. Even after the dollar lost its gold backing in 1971, it somehow kept its crown as the world's reserve currency. Here's a key reason why. In the 1970s, a crucial arrangement emerged in which the world's oil would be priced and traded in US dollars. This meant that virtually every nation on Earth needed dollars just to buy energy. That endless global demand for dollars helped cement American financial dominance long after the gold was gone. The dollar's power now rested on oil, trade, and trust instead of metal. And here's something fascinating: gold never actually died. Even today, in our world of fiat and digital money, the central banks of the world still hoard thousands of tons of gold deep in their vaults. Why? Because in a severe crisis, when trust in paper money wavers, gold remains the ancient, universal store of value that has survived every empire and every collapse. After thousands of years, humanity still can't quite let go of the original money. Gold is the quiet insurance policy sitting beneath the entire modern system. Meanwhile, physical cash is quietly vanishing from daily life. In many countries, people now pay for almost everything by tapping a phone or a card, and coins and notes are becoming rare. This cashless shift is wonderfully convenient, but it also means that nearly every purchase you make can be recorded and tracked. As money becomes pure data, it raises a profound question for the future. In a fully digital world, who controls the money and who is watching how you spend it? So step back and look at the incredible journey we've traveled. From cattle and seashells to gold coins, to paper receipts, to banknotes backed by gold, to pure fiat money backed by trust, and now to digital and cryptocurrencies backed by code. Through every single transformation, money has been evolving toward the same goal: a better, more efficient way to store and exchange value. And at its core, the deepest truth about money has never changed, not once in thousands of years. That deepest truth is this: money is, and always has been, a shared belief. A gold coin, a paper note, a number in an app, a line of code, none of these have value on their own. They have value only because we collectively agree that they do. Money is a story we all tell together, a system of trust that lets strangers cooperate across the entire world. The moment that shared belief breaks, as it did in Weimar Germany, the money becomes worthless paper. Trust is the real currency. Now let's turn this incredible history into lessons that protect your own money. Lesson 1. Understand that cash quietly loses value over time. Because we live in a fiat system designed for gentle, constant inflation, money sitting idle in a bank account slowly loses its purchasing power year after year. The wealthy understand this deeply. They don't hoard large amounts of cash. They convert it into assets that hold or grow their value. Inflation is a tax on the uninformed. Lesson 2. Own assets, not just currency. Throughout history, the people who preserved and grew their wealth were those who owned real, productive things, businesses, real estate, stocks, and historically gold. When money is being printed and inflation is eroding cash, owning a slice of valuable assets is how you stay ahead. Currency is for spending. Assets are for storing and growing wealth. Learning this single distinction can change the entire trajectory of your financial life. Lesson 3. Scarcity is the secret source of value. Gold became money because it was rare. Seashells failed where they were common. Fiat money risks its value when it's printed without limit. Bitcoin's entire appeal rests on its fixed, scarce supply. Across the whole history of money, the same principle echoes again and again. Things that are genuinely scarce and widely desired tend to hold their value, while things that can be created without limit tend to lose it. Remember that when you invest. Lesson 4. Understand the system, because those who don't are quietly controlled by it. Most people use money every day without ever questioning what it is or how it's created. But the rules of money, inflation, debt, and banking shape your entire life, often invisibly. The simple act of understanding how this system actually works puts you in a tiny minority and gives you a powerful advantage in protecting and building your wealth. Financial knowledge is one of the highest return investments you will ever make. Lesson 5. Never blindly trust that money will always hold its value. History is brutally clear. Currencies have collapsed. Empires have inflated their money into oblivion. Systems that seemed permanent have transformed completely, sometimes overnight, like in 1971. This doesn't mean you should live in fear. It means you should stay aware, stay diversified, and never assume the financial rules of today are guaranteed to last forever. The story of money is still being written, and it's changing faster than ever. Because we are living through another one of those great transformations right now. The shift from physical cash to fully digital money. The rise of cryptocurrencies challenging the entire established order. The development of government digital currencies. Decades from now, people may look back at this moment as a turning point as significant as the invention of coins or the Nixon Shock. The money of the future may look nothing like the money in your pocket today. And that future is being decided as we speak. From a farmer struggling to trade his grain, to a global network of computers securing digital coins, the story of money is really the story of human cooperation, ingenuity, and trust. It's a tool we invented to work together, one that has lifted civilizations and, when abused, destroyed them. Understanding where money came from helps you see clearly where it might be going and how to protect your place within it. The more you understand money, the less power it has to control you. So the next time you hold a banknote or tap a card or check a balance on your phone, remember the astonishing journey behind it. Thousands of years of human invention, distilled into that simple act of payment. Remember that its value isn't in the paper or the screen, but in the trust we all share. And remember that this story is not finished. You are living inside the next chapter of the greatest financial story ever told. If you made it all the way to the end of this journey, thank you. This is exactly the kind of deep, fascinating money story we live for on this channel. We break down the biggest financial events, systems, frauds, and ideas in all of history, and pull out the lessons that keep your own money safe and growing. Subscribe to Money Stories, ring the bell, and tell me in the comments, what do you think the money of the future will be? Cash, crypto, or something we haven't even imagined yet? See you in the next one.